Hey, welcome guys. I'm Reginald Campbell. Welcome to my YouTube channel. This channel is all about financial literacy, and what I try to do is I try to impart as much information as I can. Where do I get this information from, right? Well, my background is actually in television production, right? And for the past several years, I've been working in financial news. With that being said, I've been learning a lot of things, and I figured, why not take some of this information and share it with friends and people that I know. So I decided to start this webinar for friends, and then, decided to, why not just throw it on YouTube and see, if anyone can learn from this information, all the better, right? So here we are at my YouTube channel, and this is our third webinar. Today we're going to be looking at what is an asset class, right? Better yet, what are asset classes, right? Also, we're going to be looking at stock terminology, and we're going to be looking at ETFs as well, okay? Okay, great. Every video I start talking about my background and so on and so forth. Today, I'm just going to jump right into it, right? So let's look at some asset classes. Let's begin. So, as you can see from the image here, different types. You have equities, fixed income, cash equivalents, and alternative investments, right? Let's look further. An asset class. So my definition here is an asset class is a group of similar asset grouped together and are subjected to similar laws and regulations, right? That's my definition for asset classes, okay? For example, let's say you invested only in these types of products, carrots, broccoli, and spinach, as you see I have on the screen. Your general asset class would be vegetables, right? So it's like a subset of a set, right? So all those are vegetables, and those would be your investments, right? But the category that they kind of rest in would be vegetables, and that would be considered your asset class. Some might get this analogy, some may not. So let's push forward. So first type of asset class, you have, equities or stocks, right? This is on the screen here, you see an example of a PepsiCo. This is actually a PepsiCo common stock certificate. This is generally what it looks like if you get a physical stock item, okay? What is a stock, right? And again, guys, I like to kind of, give definitions as I go along for all these things. Some people might be advanced, some people may not. I try to make my webinar so that even a child can understand it, right? And then people who know a little bit more can sort of reaffirm what they already know, right? So here I have stocks are part ownership in a company, right? That's like the simplest basic explanation. Stocks are part ownership in a company, right? There are two types of stock classification, right? You have a common stock, which entitles the owner to vote in a shareholder meeting and receive dividends. And the other type we have are preferred stock, which does not allow the holder of the stock to vote. However, they receive any payout from the company's profits before the common stock shareholder, right? That kind of makes more sense when you say preferred stock, right? Also, a quick note, people with preferred stock tend to be more of like, VCs. So they really got into the company even before the company went public. Let's push forward. So the next asset class we have here is cash equivalent or fixed income securities. Okay, and here we have some images of what those are: treasury bills, checking account, money market fund, certificate of stock. Again, with my definitions, cash equivalency are investments securities that are low risk, short-term investments and are highly liquid, but provide a low return. Okay. These are T-bills, otherwise called U.S. government treasury bills, CDs or certificates of deposit. You have commercial paper. You have money market funds, right? And these are generally cash equivalent based investments, right? So as you can see, let's go back a little bit. I don't want to move too fast. Let's go back to this definition here. So cash equivalents are investment securities that are low risk, right? Which are key short-term investments, right? So they have a term limit, right? Whether 3 year, 1 year, 6 months, right? Depending on what particular cash equivalent that you choose, be it CD or money market fund, okay? And they are highly liquid, but provide low return, typically, because the returns are generally set. So you can get 4% over a 3 year period on a treasury bill, let's say, right? Bonds, another asset class. Now, bonds are debt investment in which an investor loans money to a company, government, for a defined period of time at a variable or fixed interest rate, right? So bonds similar to, in some respects, to when we went back to T-bills, right? So you have a set time period on which you can, I guess, yield interest on this particular investment. Okay, I like this actual bond specimen we have at the bottom here. This image. The next asset class we're going into here is foreign exchange, right, or FX trade. So this is kind of where my background is. I'm an FX trader. So an FX market is where currencies are bought, sold, and exchanged, right? Interestingly, it is the highest, most liquid currency in the world, right? Trading platform in the world, right? It's a typo, but think about it. You can actually trade almost every single currency on the planet, and this market only closes for a couple of hours, let's say a day, right? It's generally 24 hours besides that, right? Whereas you have, the New York Stock Exchange, CBOE in Chicago, all these platforms close. But in FX, it just keeps going because you're trading in different time zones, right? So it makes for a better opportunity, right? Better and more opportunities to lose money, but also to gain. I'm just saying, let's push forward. Also, the next asset class we're looking at here is real estate, right? That's a given. Real estate is a property comprised of land and the buildings on it, as well as the natural resources of the land, including uncultivated flora, fauna, farm crops, and livestock, water, and minerals. That sort of encompasses what real estate would be considered in the open markets, right? Now, we can invest in real estate from the standpoint of residential property, where you can buy a house and rent it out, or you can live in it. Let's say you buy a 2-family house, you can rent a section of the house and you live in the other section. Or if you prefer not to be close to your tenants, then you can, have a second home. But this is an option. The next option we have here is industrial, right? Let's say you have, storage facilities, things of that nature. You can start making some money on that. You also have commercial, right? Office buildings, storefronts, things of that nature. You can, and again, real estate is one of the best investments anyone can possibly make if done properly. But yeah, it's one of the top tier asset classes here in this presentation. Next one we're going to be looking at is commodities, right? You can buy oil, you can buy gold, silver, corn, right? Grain. You can buy them, you can sell them on the open market, right? This is another asset class. What's a commodity? Here's my definition. A commodity is a basic good used in commercial that is interchangeable with other commodities of the same type. Commodities are most often used as inputs in the production of other goods or services. Okay? Let's push forward. So it goes without saying, right? Again, let's reiterate it. For these definitions, I like to really drill it in because I feel like these items, the explanation for them in video form or webinar form is seldom on the internet. So again, so a commodity is a basic good used in commerce, that is interchangeable with other commodities of the same type. Commodities are most often used as inputs in the production of other goods and services. Okay? Popular commodities, I mentioned earlier, right? You have grain. Different types of grain can be traded, right? Oil, which is the big one. I mean, I'm sure, you guys have been watching, the news, perhaps Bloomberg, perhaps other networks who carry financial news, and hear them talking about oil or read it in newspapers or online, right? Gold, right? Gold is used to be the standard in America, but it changed over time into the almighty dollar, right? But gold can still be bought and sold, or is still bought and sold throughout the world on the open market. So these are essentially the primary, some of the primary commodities that are being traded heavily on a day-to-day basis on the open markets. Now, let's push into stock terminology, right? Because I mean, why would you want to trade or invest and not have an idea as to what things mean, right? That was my thought process in putting together this little quick rundown of what terminologies. Let's even start with this image here, right? You have the bear, you have the bull, right? And you also have these arrows that sort of indicate what they represent. A bear market typically is when the market is, investors are selling off. And as a result of the investors selling off, the market goes down, okay? The bull is a representation of when the investors are buying heavily in the markets. And as a result of that activity, the market goes higher, right? So that's essentially the idea between the bear and the bull markets, okay? Further definitions here, and we can run through it just with one-liners. Bear market, this means that the stock market is in a downtrend as a result of falling stock prices, right? Bull market, this means that the stock market is in an uptrend. Pretty straightforward. A broker, who is a broker, right? For a lot of investors who, persons like you and I, who don't necessarily have the time to, sit around a computer and watch the stock markets day in and day out, we employ someone that's known as a broker, right? And they broker our investments for us. They're sort of like the go-between, right? They're the go-between between us and the asset class or the particular investment that we wish to purchase or sell, right? So broker is a person who buys and sells an investment for you in exchange for a fee, right? And the fees, is something to note here because, this could be a big factor in any investor's portfolio, the fees that you pay for investing in different assets, okay? Let's continue. Blue chip stocks, right? Blue chip stocks are nationally recognized and well-established and financially sound company, right? So blue chips are essentially big companies that invest. For example, Pepsi, right? Coca-Cola, These are big companies. Apple at the moment, right? Facebook's become huge, right? Amazon, and the list goes on and on. These are like behemoth companies. These would be considered blue chip stocks, okay? Dividend. This is important. This is a portion of a company's earnings that is paid to shareholders or people that own that company's stock. Sorry for my typos here. On a quarterly or annual basis. Not all companies do this, right? So you can buy a stock option and then you realize, I'm not getting any payout. Well, you'd have to do your research before buying it and make sure that this company that you're looking to buy actually pays a dividend, right? Because that's how you make money, right? Besides Warren Buffett's method of buying and holding and watching your stock rise over decades, right? A lot of us may not have that sort of time. We might be, more active in the market, so we decide to trade as opposed to buy and hold. It's all up to you. Let's push forward. So we have volatility. What is volatility? So this refers to the price movements of a stock or the stock market as a whole. Highly volatile stocks are ones with extreme daily up and down movements and wide intraday trading ranges, right? And all this simply means is the volatility is basically the movement of that asset class, right? On a given day, on a given week, in a month, in a year. It's just the movement. How busy is this particular asset moving? Is it being bought and sold rapidly, or is it just flatlining, right? Well, if it's flatlining, that's pretty much, you don't want to be, you don't want to own that at all because that's going nowhere, right? So again, volatility refers to the price movements of a stock or the general stock market, right? Highly volatile stocks are ones with extreme daily up and down motion or movement, right? And wide intraday trading ranges, okay? Let's look into some more definitions here. Volume, the number of shares of stock traded during a particular time period, normally measured in average daily trading volume, okay? Again, volume is a number of shares of stock traded during a particular time period, normally measured in average daily trading volume, okay? Yield. This usually refers to the measure of the return on an investment that is received from the payment of a dividend, right? So again, we mentioned the dividend before, which is the payout that companies give you if they made money and decide to pay, share some with you as minority shareholder or majority, depending on who's watching this. But yeah, so it would be considered a yield, right? So the company paid something out, right? And you benefited from the yield, right? A yield, if you look it up, it means actually to give, right? Stock symbol, right? A 1 to 3 character alphabetic root symbol, which represents a publicly traded company on the stock exchange. For example, if you look up Apple's stock symbol, you'll see AAPL, right? So every single company that trades on the open market, they're listed not as Apple or Geico or Berkshire Hathaway, right? They're all abbreviated. And they use 1 to 3 characters, okay, as a representation. Let's look at some more definitions here. This image is actually, for those who've probably watching it and never been to New York, this is the outside of, this picture is of the outside of the New York Stock Exchange. All right, portfolio. What is a portfolio, right? You've probably heard people say, oh, my portfolio is doing well or it's doing bad or, so on and so forth. So a portfolio is a collection of investments owned by an investor, right? You can have as little as one stock in your portfolio, right, to an infinite number of stocks and or other asset classes, okay? An IPO, right, or an initial public offering, IPO. What is this, right? As you can see here, it's the first sale or offering of a stock by a company to the public rather than just being owned by a private or inside investors, right? Inside the company, or rather than just being owned by VCs. Like, there's a lot of big companies out there, big in the sense of their value, that are actually owned privately. You might have a small group of extremely wealthy people that own this particular company, right? But we're not talking about those companies. We're talking about public companies, the ones that you can actually, as an average person, you or I, can go out and go online and purchase a piece of stock in those companies. Facebook, you can buy a stock if you have the money to. Amazon, you can go out and purchase a stock of that. Or what I like to tell people is, look around your house, look around your environment, and you might be able to see things in there that you can purchase a stock of the company that actually produces that item. Okay, let's push forward. An index. What is an index, right? An index is an indicator or measure of something, and in finance, right, it typically refers to a statistical measure of change in a securities market, right? For example, the NYSE, the S&P 500, and the FSTE, or FTSE 100. That's in the UK. In the US, an index is NYSE, which is the New York Stock Exchange, S&P 500, and others, right? And it's simply an exchange, or they have or hold a collection of stocks that they follow, right? So you can actually purchase the S&P 500 that follows closely all the stocks that they hold. S&P 500, that means they hold 500 of the biggest companies in America, right? So you can actually go out and purchase an index fund, right? And when you do that, you'd be purchasing it from one of these sorts of institutions, the NYSE, the S&P 500, or the FTSE if you're really knowledgeable in investing and you're looking to invest in other markets outside the United States, okay? You also have the Russell and others in Europe. Just push forward. All right, so let's look at ETF, right? This is kind of my favorite sort of fund. And, we'll talk about it. All right. An ETF is a type of fund which owns the underlying assets, example, a share of stock, bonds, oil futures, gold bars, foreign exchange, etc., and divides ownership of these assets into shares, right? So it's like the analogy I like to give is that it's kind of like a basket. An ETF, you can buy an ETF basket of tech stocks. You can buy ETF basket of currencies, right? So within that ETF fund, you have, let's say you're looking at a tech ETF. You'd have, Amazon, you have Facebook, you have, got all the tech companies in that basket, as opposed to you just going out and purchasing one share of one of these companies. You can actually purchase an ETF and own a piece of all those companies, which is why I tend to lean a bit towards ETFs. But, that's kind of my little pet peeve. Now, to round it off, I'm just going to play this video, which I think does a little bit better of explaining and breaking down in animated form an ETF. Okay? So let's take a look at this.
Exchange-traded funds, or ETFs, are securities that are created to behave the same way as a specific index or a collection of different securities. This means that the ETF will track or move in tandem with the securities it is designed to follow. Dean Brothers Investment Bank is creating an ETF to track the performance of the oil sector. Dean Brothers submits a detailed plan to the SEC explaining how it will make the fund and what stocks will be in it. After approval, Dean Brothers contacts other firms and funds that hold the stocks to be included in the ETF. These stocks are assembled and delivered to a custodial bank. Dean Brothers Oil ETF shares are then created based on the equivalent value of the pool of shares in the custodial bank. The firms involved can now sell their ETF shares to other investors on the market. In theory, when an investor wants to sell an ETF, he can redeem ETF shares for the stock held at the custodial bank and then sell those shares on the market. However, it is much more common to simply sell the ETF shares because they trade at the same value as the underlying shares. Although it is possible that an ETF can trade for more or less than the value of the underlying shares, this difference is minimized by investors who exploit even the smallest ETF arbitrage. There are many types of ETFs focusing on specific indexes, market segments, and even entire countries. ETFs give investors the ability to diversify over a broad market sector with a single investment.
All right, so I hope you guys kind of got a better understanding of the power of an ETF here from this video. Now here we are at the end. We kind of wrapped up pretty quickly today. Again, let me bring my video back up. Hey, all right. So thanks for staying with me. Really appreciated it. Please remember to like, share, subscribe to my channel. I'm going to be trying to push out as much of this information as I can. It all depends on the feedback I'm getting from you guys. Please leave a comment. If you like it, you hate it, whatever. It's a democracy here as far as the comments go. So again, thank you for joining me. My name is Reginald Campbell, and looking forward to the next installment of Financial Literacy. Take care.